Most people buy stocks based on a feeling, a hot tip, or just guessing which ticker symbol might jump next. But consistently making money requires stripping away that noise and replacing it with a calculated step-by-step method. This infographic outlines the ultimate 10-point checklist for vetting a stock. It maps out the anatomy of a healthy company, starting from its foundational roots all the way up to its future growth. Looking at 10 separate data points all at once can be overwhelming, so we are going to group these 10 nodes into a highly practical 5-step workflow that you can execute in a single sitting. To get the most out of this, pull up a free financial data platform right now and pick one specific stock you want to research as we go. By following these 5 steps in order, you stop gambling on price action and start building a logical, verifiable case for why a company deserves your money. Step 1 maps the company's footprint. Look at market capitalization first. Its size reveals baseline liquidity. Next, identify the core product to verify a scalable competitive edge. Finally, check revenue location. You need geographic diversity so a local downturn won't wipe out earnings. A strong foundation means you have confirmed the company sells a defensible product to a stable, diversified market ecosystem. Step 2 looks under the hood at the company's financial engine. Navigate to the Financials tab and check the income statement and cash flow for a track record of consistent growth. Then look at 3 key ratios: PE, ROCE, and debt to equity. These dials measure valuation, operational efficiency, and financial leverage. They have to remain balanced. If a business takes on too much debt, it drags down their ability to generate efficient returns. This is your primary go or no-go checkpoint. If you see stagnant profits or a suffocating debt load, pass on the stock. Step 3 contextualizes the stock against the test of time and direct rivals. This chart shows historical results. Look at a 5-year window to confirm long-term consistency, helping you weed out companies that just had one lucky year. The metric you want to focus on here is CAGR, or compounded annual growth rate. It smooths out the year-to-year volatility and gives you the true average rate of return over that historical period. Next, line the stock up against the sector leaders. You need to see if your target company holds a relative valuation advantage compared to the rest of the pack. A stock's internal numbers don't guarantee success. It's only a strong buy if the data proves it consistently beats direct rivals over a sustained timeline. Step 4 uncovers who controls the equity. Check the shareholding pattern. An ideal pie chart shows heavy backing from insiders and institutional investors. Be cautious if the stock is entirely dominated by retail ownership. When scanning the news, only check for earnings calls and regulatory changes that impact the business. Finally, Step 5 verifies the future pipeline to ensure there are tangible catalysts for upcoming growth. Go into recent corporate presentations and look for growing order books, new product launches, or active construction sites. Historical data tells you where the company has been, but strong ownership and an active pipeline dictate exactly where the stock is going next. And just like that, the 5-step framework is complete. It proves complex research can be executed rapidly when you know exactly what to look for. You have now taken a random ticker symbol and processed it into a fully realized, deeply researched investment thesis. Applying this specific sequence inherently lowers your risk because it exposes the full fundamental picture of the business before a single dollar of your capital is deployed. So here's your challenge. Open your current portfolio, take your largest holding, and run it through this exact 5-step framework right now to see if it survives the test. Because in the market, rigorous, independent research always beats borrowed conviction.